Barings Bank, Britain's oldest, collapses due to a single trader's bets. It's Barings Bank, one of the oldest and most respected banks in the UK. But in 1995, Barings collapsed, costing £827 million. How did this happen? In 1995, Nick Leeson, a young and ambitious trader at Barings Bank, made significant profits for the bank through risky derivative trading. However, this trading was conducted without the knowledge or approval of the bank's management. Nick Leeson was supposed to follow strict rules, but he didn't. He hid his losses and lied to his bosses. The biggest loss came from the 1997 Asian financial crisis, which affected the Japanese stock market and derivatives trading. Nick lost millions of pounds, but he kept it a secret until it was too late. Barings was in trouble, but why? The bank's books should have reflected the losses. However, Nick Leeson's schemes hid the truth. His secret trades were like a ticking time bomb, just waiting to explode. The day of reckoning came on February 23, 1995. Nick was out of the office. His bosses couldn't hide the losses anymore. $3 billion at the time. That's about the price of 130 million used cars. Barings Bank collapsed in 1995. The news shocked the world. One of the oldest banks in the UK was suddenly gone. What happened? Nick Leeson had been making high-risk bets on Japanese stock index futures. He was essentially gambling with the bank's money, thinking he could win big and cover his losses. However, the market turned against him, leading to Barings Bank's catastrophic failure in 1995. The losses piled up and Nick Leeson couldn't cover them. He borrowed money from other banks, thinking he could win back the losses, but the more he borrowed, the deeper he sank. Here's the math. Nick Leeson's biggest loss was approximately £858 million, which is equivalent to about £858 million. To put this into perspective, that's about the price of 85,800 used cars, assuming an average price of £10,000 per car. Imagine losing that much money. That's what Nick did, and he hid it all. Now, how did this happen? Barings Bank had a strict system to monitor its finances and prevent risky trades. However, Nick Leeson found a way to bypass these controls. He lied to his supervisors and covered up his losses. The bank's internal controls failed and the losses continued to accumulate. Imagine if you were a bank manager. You'd expect to see all your trades and financial positions clearly. But with Nick Leeson's manipulations, the bank's books appeared fine until it was too late. That's how Barings Bank went bankrupt in 1995. So why did Barings fail? There are three big reasons. 1. Lack of oversight. Nick Leeson had excessive freedom to conceal his losses. The bank's internal controls and oversight mechanisms were supposed to detect such issues, but they failed to do so. 2. Poor risk management. Barings lacked robust risk management systems, allowing Nick Leeson to take on significant risks with the bank's money. 3. Culture of secrecy. Barings had a culture where issues were often not discussed openly, which allowed Nick Leeson to conceal his mounting losses. Imagine you're a trader, you make a risky bet and it goes wrong. What do? You report it, but Barings Bank trader Nick Leeson didn't. He kept lying and hiding until it was too late, ultimately leading to the bank's collapse in 1995. Barings had a chance to catch Leeson's mistakes early, but they missed it. They trusted him too much and did not properly oversee his work. Let's look at the numbers. $3 billion at the time's exchange rate. That's a huge amount, but it's not just about the money, it's about how Barings let this happen. They had systems in place, but they didn't use them properly. Nick Leeson's biggest loss was on February 26, 1995. The market closed and his losses were clear. He didn't report them. The next day, his bosses had to report the loss to regulators. Then it was too late. So how did Barings lose so much money? Nick Leeson was making risky bets on the Nikkei index, a major stock index in Japan. He thought he could make a lot of money by betting on its movements. However, the market moved against him and he lost big. Imagine you're betting on a horse race. You put all your money on one horse and it loses. That's what Nick Leeson did, but with millions of dollars at Barings Bank, leading to its collapse in 1995. Now let's talk about the impact. Barings Bank had been around for nearly 230 years. It was trusted by customers, other banks, and the public. But in just a few weeks, it all fell apart. The bank went bankrupt and Leeson was arrested. Barings collapsed due to one man's mistakes, highlighting the critical importance of having robust controls and oversight in banking. Trust alone is insufficient. Banks must implement thorough checks and double checks to prevent such failures. Now, why did Nick Leeson do this? He was young and ambitious, seeking to prove himself and make a significant amount of money. However, he took enormous risks and concealed his mistakes. This is a cautionary tale about the dangers of risky behavior and the lack of proper oversight. Barings' collapse was a wake-up call for the banking industry. It demonstrated that even long-established, respected banks can face catastrophic failures if they lack robust internal controls. Following Barings' collapse, other financial institutions began to implement stricter regulations and increase vigilance in risk management. So what can we learn from Barings Bank? First, robust oversight is crucial. No matter how trusted an individual is, their work must be regularly reviewed. Second, engaging in risky behavior can lead to severe consequences. Third, transparency is essential. Mistakes should be reported openly rather than concealed. Let's take a look at the numbers again. Nick Leeson lost £858 million, equivalent to about 85,800 used cars at an average price of £10,000 each. Imagine losing that much money. It's a staggering amount, and it shows how quickly things can go wrong. Barings had an opportunity to detect Nick Leeson's mistakes early. However, the bank failed to do so due to excessive trust in him and inadequate use of their internal controls. This incident serves as a classic example of how one person's actions can have a significant impact on an entire organization. Now let's talk about the aftermath. After Barings collapsed, Nick Leeson was arrested and charged with fraud. He was sentenced to 6.5 years in prison. He was 28 years old at the time. The collapse also had a ripple effect. Other banks became wary of trading with Barings, which impacted market confidence. The cost to Barings' parent company, the Bank of Nova Scotia, was approximately $1 billion, which is roughly equivalent to the cost of 10,000 used cars. Barings' collapse in 1995 was a major event in financial history. It highlighted the dangers of risky trading and inadequate oversight. This led to significant changes in banking regulations, introducing stricter rules and enhanced oversight to prevent similar collapses. So what can we take away from this story? First, strong oversight is critical. Second, risky behavior can have devastating consequences. Third, transparency is essential. If a mistake is made, it should be reported, not hidden. Now let's look at the broader impact. Barings' collapse wasn't just a story about one bank. It highlighted the importance of regulation and oversight in the financial industry. The event led to significant changes in how banks manage risk and handle their traders, emphasizing the need for robust internal controls and regulatory checks. Barings' story is a reminder of how quickly things can go wrong in finance. It underscores the importance of having robust checks and balances in place. No matter how trusted or experienced an individual is, their actions must be closely monitored. So the next time you hear about a big financial collapse, remember Barings Bank. It's a lesson in the dangers of risky behavior, the importance of proper oversight, and the need for transparency. In short, Barings Bank's collapse was a wake-up call for the entire financial industry. It highlighted the critical need for strong oversight and transparent practices. No matter how long-standing or respected a bank is, it can face significant risks if it lacks proper controls. The collapse of Barings Bank highlights the dangers of excessive leverage. Nick Leeson, the trader responsible, was able to take on massive positions because Barings had high leverage ratios, allowing the bank to borrow heavily to amplify its trading power. This risky strategy magnified potential gains, but also increased the risk of severe losses. When the markets turned against Leeson, the leverage amplified the losses, leading to the bank's collapse. Another key factor was the lack of transparency in Barings' reporting systems. Leeson was able to hide his losses by manipulating the accounting records, which should have been detected by regular audits and robust internal controls. However, Barings, like many institutions, had become complacent over the years, assuming that their long-standing reputation was sufficient to prevent such disasters. The ripple effects of Barings' collapse were significant. Other financial institutions and regulators took notice and began implementing stricter rules and oversight. This led to reforms, such as the requirement for more frequent and detailed reporting and the establishment of stricter risk management practices, which are still in place today. Barings' story underscores the importance of psychological factors in financial collapses. Leeson's gambling mentality and the pressure to meet targets led him to take increasingly risky bets. This behavior was enabled by the lack of a strong corporate culture that emphasized ethical behavior and robust risk management. A robust internal culture could have caught these warning signs early on. In the wake of Barings Bank's catastrophic trading losses, the financial industry recognized the need for more stringent background checks and continuous training for traders. This includes regular psychological evaluations and ongoing education on ethical behavior and risk management. The industry also began to emphasize the importance of whistleblower systems, where employees can report suspicious activities without fear of retaliation. The collapse of Barings Bank serves as a stark reminder that financial institutions, no matter how established, must remain vigilant. It's a cautionary tale about the consequences of unchecked risk-taking and the critical importance of robust oversight and transparency. Tomorrow on the Money Files, economic impact of rich consumers on travel industry. This is educational and historical, not financial advice.